For the past few years, anyone trying to buy or sell a home has been on a wild ride. We went from the frenzied, over-asking price bidding wars of the pandemic to a market that felt frozen in place by whiplash-inducing mortgage rates. Sellers had all the power, buyers felt completely locked out, and a sense of paralysis took over. But that era is ending. We are entering a new phase for the U.S. housing market, a trend that some in the media, drawing on analysis from firms like Redfin, have dubbed the Great Housing Reset. What does this new market actually look like? Forget the boom and forget the bust. The story for 2026 seems to be all about normalization. We spent weeks digging through the latest forecasts from the nation's top housing economists to figure out where this is all headed. And if you're waiting for a crash, the predictions for home prices and mortgage rates might surprise you. Stick with me as we break down what the experts are projecting for 2026, and more importantly, what it means for your money, whether you're looking to buy, sell, or just stay informed. To understand where we're going, we have to be honest about where we've been. The last few years were all about extremes. First, the pandemic boom created an almost hysterical seller's market. Homes were selling in hours, buyers were waiving every contingency you can imagine, and prices soared at a pace that just wasn't sustainable. Then, as the Federal Reserve moved to fight inflation, mortgage rates shot up, climbing from under 3% to over 7% at their peak. This sudden spike in borrowing costs threw the market into a deep freeze. Affordability hit its worst levels in decades, creating the now famous golden handcuffs effect. Why? Because data from the 2023-2024 period showed that a huge majority of homeowners, roughly 3/4 of them, had a mortgage rate below 6%, with many locked in down in the 2s and 3s. The financial incentive to just stay put was enormous. Think about it. Why would you sell your home and trade a 3% mortgage for a 7% one, effectively doubling your housing payment for a similar house? The result was total market gridlock. The number of existing homes sold fell dramatically, hitting a roughly 30-year low in 2023. The intense, chaotic seller's market of the pandemic faded, but it didn't flip to a buyer's market overnight. Instead, we entered a strange limbo. Inventory stayed stubbornly low, which kept prices from crashing, but the high rates kept a lid on buyer demand. This has been the frustrating reality for millions, a market that's too expensive to buy into, but too valuable to sell out of. This is the core problem that 2026 is finally beginning to solve. So, what does the path forward look like? We've looked at a wide range of forecasts, and while the exact numbers differ, a clear theme is emerging for 2026. A slow, gradual return to a more balanced and sustainable housing market. This isn't a dramatic crash or another boom. It's a story of moderation. Let's break it down into the two pieces that matter most: mortgage rates and home prices. First, let's talk mortgage rates. This is the key to unlocking the market. The general consensus among many economists is that we'll see continued, modest relief in 2026. Most baseline forecasts suggest that the average 30-year fixed mortgage rate will spend the year hovering in the low to mid 6% range. Some of the more optimistic outlooks even see rates possibly dipping just below 6% by the end of the year. Why the expected decline? It's all tied to the broader economy. Forecasters believe that as inflation continues its slow cooling trend, the Federal Reserve will have room to begin cutting its benchmark interest rate. The Fed doesn't set mortgage rates directly, but its policy heavily influences the 10-year Treasury yield, which is what mortgage rates tend to follow. But let's be clear, no one is predicting a return to the 3 or 4% rates of the pandemic era. The journey down will likely be gradual, and we should expect rates to remain above 6% for much of the year. The key takeaway is the direction: down, but slowly. Now, what about home prices? If you've been on the sidelines waiting for a 2008-style price collapse, the expert forecast suggests you'll be waiting a very long time. The consensus for 2026 points toward a market with flat to very modest price growth. Think low single digits. For example, some prominent forecasts from groups like Realtor.com and the National Association of Realtors see prices appreciating somewhere in the 2 to 4% range. This reflects a market being pulled in two directions. On one hand, low inventory is still acting as a floor, preventing prices from falling. On the other hand, the ongoing affordability crunch, even with slightly lower rates, will keep a tight lid on how high prices can go. However, not all forecasts are positive. Zillow's most recent public model, for instance, actually projects a slight national price decline of about 1.7% from early 2025 to early 2026, highlighting that there's still plenty of uncertainty. This is what some are calling the Great Housing Reset. Not a quick correction, but a years-long period where home prices are expected to grow more slowly than incomes, allowing affordability to gradually improve. Finally, what does this mean for sales? The gridlock is expected to slowly ease. As rates tick down, more buyers can qualify for a loan, and the lock-in effect for sellers begins to weaken. The gap between a current 3.5% rate and a new 6.1% rate is still large, but it's much less scary than the gap to 7.5%. As a result, most forecasts call for a rebound in home sales. Projections for growth vary, with some modest estimates around 2 to 3%, while more optimistic scenarios see a potential double-digit jump as pent-up demand is finally released. Okay, so data is one thing, but what does this all mean for you? Let's translate these predictions into a strategy. For buyers, 2026 could be a window of opportunity, but it requires a new mindset. The crazy competition of the past is easing. We're moving away from a pure seller's market and towards something more balanced. This means you may see the return of things that were once normal. The ability to negotiate on price, ask for repairs, and include contingencies in your offer without being laughed out of the room. Inventory is also slowly ticking up, giving you more to choose from. The biggest change will come from that modest drop in mortgage rates. A move from, say, 6.7% to 6.0% might not sound like a revolution, but it has a huge effect on your wallet. On a $400,000 mortgage, the principal and interest payment at 6.7% is about $2,580 a month. At 6.0%, that payment drops to around $2,400. That's a saving of $180 a month, or over $2,100 a year. Over the 30-year loan, that small rate difference could save you over $65,000 in interest. This improvement, however small, expands the pool of buyers. So while you'll have more power than you did in 2022, don't expect a dead market. There is a deep well of pent-up demand from millennials and Gen Z who are in their prime home buying years. Now for sellers. If you've been waiting for that perfect moment to cash out, you need to know the game has changed. The strategy of listing your home at an absurdly high price and expecting a bidding war is over in most places. In this new, more balanced market, getting the price right from day one has never been more important. Overpriced homes are sitting on the market, and price cuts are becoming normal. The good news is that home values aren't projected to crash. The underlying supply shortage should support your home's value, but you will have to compete. This means investing in presentation, making sure your home is clean, decluttered, and marketed well. You should also be ready to negotiate. An offer might come in a bit below asking, or a buyer might ask for help with closing costs. That's not a weak market, it's a normal one. Navigating this shifting market can be tricky, and the national headlines don't always tell you what's happening on your street. If you want to stay ahead of the curve and get insights tailored to your local area, make sure you subscribe and hit that notification bell. We break down the latest data every week to help you make smarter moves. One of the most critical themes in every 2026 forecast is regional divergence. The idea of one single, quote, U.S. housing market is becoming less true every day. Where you live will massively impact your experience. A clear trend is emerging: the resilience of markets in the Northeast and Midwest. Cities in these regions are becoming refuge markets for buyers seeking affordability. Forecasts from both Realtor.com and Zillow show many of the strongest markets are expected to be in places like Hartford, Connecticut, Providence, Rhode Island, and various metros in Ohio and Pennsylvania. These areas often have stable jobs and, crucially, home prices that didn't skyrocket like in other parts of the country. On the flip side, many pandemic boom towns in the South and West are facing a cool down. Cities in Texas and Florida are seeing more new construction, which is helping ease the supply crunch and flatten out price growth. These regions are also dealing with rapidly rising homeowners insurance costs driven by climate risks. In some coastal areas, this is already weighing on buyer demand. For example, recent Zillow forecasts for markets expected to see price declines include several cities in states like Louisiana and Texas. This doesn't mean the entire Sun Belt is in a downturn. Real estate is hyper-local, but it does mean that buyers and sellers in these different regions are playing on very different fields. Knowing your local market's specific trends has never been more important. Beyond buying and selling, there's another major shift on the horizon for 2026, a potential surge in mortgage refinancing. Think about everyone who bought a home in late 2023, 2024, and 2025 with mortgage rates of 6.5%, 7%, or even higher. By some estimates, roughly 20% of all homeowners with a mortgage now have a rate above 6%. For these homeowners, a drop in market rates into the low sixes or high fives is a powerful financial incentive. As a result, many analysts are predicting a significant increase in refinance activity, with some suggesting that refi volume could surge by more than 30% in 2026. As millions of homeowners refinance into lower monthly payments, it will free up cash. That extra money can be used for spending, saving, or quite often, home renovations. This could in turn provide a nice boost to the remodeling industry. If you have a rate over 6.5%, 2026 should be the year to watch rates closely and be ready to act when the numbers make sense. So, what's next for the housing market? The frantic, unpredictable market of the pandemic is being replaced by something far more stable, even if it's still challenging. The consensus from expert forecasts for 2026 is clear. This is not a market on the verge of a crash. It's a market that's normalizing. Here's the bottom line. First, expect modest relief on mortgage rates, with most forecasts pointing to a gradual slide into the low to mid 6% range. But don't hold your breath for 3%. Second, home prices are expected to stabilize nationally, with projections ranging from slight declines to low single-digit gains. Third, the market is slowly rebalancing, giving buyers more breathing room and negotiating power than they've had in years. And finally, where you live matters more than ever, with some Midwest and Northeast markets showing strength while parts of the Sun Belt cool down. The story is one of a slow thaw. The gridlock that defined the market is beginning to break, creating opportunities for those who have been waiting. Whether you're a buyer tired of being priced out or a seller who has felt locked in, 2026 is shaping up to be a year of movement and a return to a more rational, predictable housing market. Making the right move in real estate is one of the biggest financial decisions you'll ever make. Staying on top of the data is the best way to do it with confidence. Thanks for watching.